Welcome to Shaken Not Burned, a cocktail of solutions for a sustainable future. I'm Felicia Jackson.
And I am Giulia Bottaro. Each week we interview experts to talk about parts of the sustainable transition and what you and your business need to know to succeed.
Sustainability is complex and constantly evolving, and it can be hard for a business to adapt and remain competitive.
We are here to help you learn all about the changing economy and the ongoing transition.
So join us as we explore the concepts and the tools you need to plot a course for a sustainable future. Hello and welcome back to another edition of Shaken Not Burned. Today we're going to talk about one of the big existential questions for business, climate risk. 2024 was the year that we hit global average temperatures of 1.5 degrees for the first time. And while it looks as if global temperatures next year may drop below that, there's absolutely no question that we're on a certain trajectory. That means there's a whole load of risks that we need to be aware of. One of them is the obvious one, the extreme weather that we've seen increasing all over the world, whether it's drought or floods. But there's so much more to it. There are risks for business around resilience of the supply chain. There are risks around compliance and new regulation. There's liability and who's going to be held accountable for the ravages of climate change. But in the end, companies have got to find a way of navigating through the problems. So today we're lucky enough to be joined by Tom Sabatelli-Goodyear, who's the Vice President of Climate Risk at FIS. Tom, welcome to the show.
Hi, Felicia. Thanks for having me. Nice to meet you.
Very nice to meet you too. So could you talk me through what the different types of climate risk are?
Yeah, let me briefly say a word about FIS, if I may. It's an interesting situation to be able to introduce a 55,000 person company to the sustainability world, because I keep talking to people in this space about how FIS is the largest company that the sustainability community has never heard of. We always say to people, you may not have heard of us, but we're probably embedded within your company because we've got 55,000 employees. We've been around for over 50 years. But this is FIS's kind of introduction to this space because we have grown in time. We started as a payments company, and that's how we started our relationships with many corporate clients. But we've grown in time to expand into treasury and risk solutions, and we've got about 1,500 different risk clients. And so climate risk is a big area where we see this as the next urgent risk for companies to be aware of. And so we're leveraging a lot of the technologies that we've had through working with our companies and working with our clients in this space for many years to bring to bear a climate risk solution. We launched that called Climate Risk Financial Modeler. And the types of risks that we're thinking about are very relevant for the climate conversation that we're going to have today. When you think about some of the overall risks that companies are facing and the things that are keeping experts up at night, one great data point is the World Economic Forum has its risk perception survey that they do every year. And they interview about 1,500 experts in business and academia and in other fields. And they say, well, rank your top risks that you're thinking about for not just the next 10 years, but even more short term than that, than the next 2 years. And it's no surprise to see that big environmental risks show up on the 10-year list, right? Things like extreme weather, pollution, biodiversity and nature, so on and so forth, right? The environmental risks really dominate the top 5 of that list.
Really interesting thing to me, though, because we're consistently seeing this. I've followed the WEF survey for years, and we're always seeing the environmental and climate risks as something in the future.
Yes.
The whole point about this year was it's happening now.
Precisely. And if you look at that 2-year list, though, as you said, quite rightly, a lot of those risks drop off, but the one that remains is extreme weather. And so this is now, I think, a shift in which people are saying it's not just a 10-year conversation, because we absolutely see that some of the broader risks we'll talk about in a second, like transition risks, those are multi-year risks, but the 2-year or even today kind of risk is the extreme weather. So that's what we call the physical aspect of climate change. And that can be broken down into what we call acute and chronic risks. So the extreme weather risks that you think of, like storms, floods, wildfires. Those are kind of acute risks that can happen over the course of days, weeks. We see plenty of headlines of how these acute risks are increasing in frequency and severity around the globe. And then when you think about the chronic risks, these are things that will continue to compound in time if carbon emissions continue to be emitted into the atmosphere. As you said earlier, if we're on a certain pathway, these chronic risks could continue to compound themselves. Things like sea level rise, things like drought, that yes, they have some materiality today, but are expected to be far more material in the future if we continue on the pathway that we're on.
So would it be fair to say that when we're differentiating between acute and chronic risks, the acute is what's going to happen today and you have to have a plan to deal with it. And the chronic is the way in which overall the environment is changing, meaning that we have less resilience and we're going to be less capable of responding to these shocks?
I think that's a great way of putting it. I think that when I have a degree in meteorology, and when we were doing our research about 20 years ago, the conversation was about 2100. What does the world look like in 2100? And I think that it's no longer a question of when, it's happening now. And so,
And how bad it's going to get.
And how bad it could get, exactly. So there's a baseline level of risk that's happening right now, and then there's a spread of risk of how much worse could it get. Even in a net zero situation in which we reach our stated goals as we want to by 2050, for example, there's still carbon that's emitted into the atmosphere between now and 2050, hopefully decreasing in time, but still the more we emit, the more the weather patterns change, the more that the risks become more severe. And so we don't expect that even in a net zero world that we're rolling back to a previous era of lower extreme weather. It's just now a spread of how much more severe could it get. And in terms of how that's translating into different effects on businesses, it's business interruption in your supply chain within your own operations, damage to your facilities and the associated cleanup costs, labor productivity in terms of, humans can only really cope with such extreme conditions. It comes back to the chronic idea of growing heat. In a physical labor environment, humans can only withstand such conditions. So you might have a decreasing productivity within a workforce. Shipping routes may be affected. Crops, the yield of crops are going to change based off precipitation and temperature changes. So the whole span of physical risk and the impact that it can have is quite wide.
I think about the idea that net zero is actually a plan to just stop things getting worse. It's not to make things better. It's not this sort of magical goal which is going to mean that we've addressed climate change. It just means a means of managing to not make it worse.
That's absolutely right. Yeah.
And that doesn't seem to be being communicated very well.
I think that it's a good thing to be able to have a goal in mind. And I think that the communication around this, it's in order to make it mainstream, there is always a risk of overcomplicating it and trying to, we deal in sound bites these days, right? And so in order to really help get not just businesses, not just the economy, but, to get society understanding and getting on board with a lot of these goals, I think we have to narrow the focus to make the message very direct and very tangible, because I think
a lot of sense.
Once we start getting into things that may be perceived to be more technical, then I think that becomes a more difficult conversation to have with the general public.
It's really confusing because you're hearing different messages from different people at different times, depending what their particular concern is at any given moment. So we're talking about extreme weather and acute risks. And you've mentioned the idea that there might be risk to facilities or productivity. I've heard about cities where they're implementing working at night rather than during the day because of the heat problems. But I suppose I'm wondering what the implications are, the sort of knock-on implications. What are the risks around supply chain or even the provision of insurance? What do we need to worry about?
And it's, again, coming back to the conversation of what's happening today, you don't have to look very far in the headlines to see where this is happening and how this is impacting businesses. When we speak to companies about this, they are living and breathing this on a regular basis. If you think about it on a supply chain basis, disruption that's happening in terms of the availability of materials to build products or the transport of those materials is already being threatened. So a really interesting example of this is in the summer, Porsche had to issue a profit warning off the back of a disruption that they had in their aluminium supply. So they had a supplier in Germany who they were reliant on, and I think other automakers were also reliant on this supplier for their aluminium. It was situated on a river in Germany, and there was a severe flood that basically kind of cut off the facility's ability to distribute the aluminium. And it had a knock-on effect on Porsche's manufacturing capability. And the day after they issued that profit warning, their stock took a 3% hit. So that's a really bottom line impact. It couldn't be any clearer than the stock price impact. This is just one example of how this is flowing through, in terms of maybe not just the acute perils, but the chronic perils. 2 years ago, there was a very historic heat wave and drought that impacted China, and it cut off limited hydropower availability to a number of the manufacturing facilities that are in the country. And so you had automakers like VW, Toyota, and others who had to shut down processing at those facilities because of the lack of hydropower availability. So, again, it's not just those acute perils that we say are happening today, but you're even starting to see some evidence of the chronic perils coming into play.
That's really interesting when you consider that a lot of the conversation about the challenge on achieving net zero is the need for energy security and the fact that we need to have more gas because of that. And it's like, yeah, but the more gas we have, the more CO2 we have and the more methane we have. So the worse that problem becomes. That's a really, really difficult issue I suppose it's the trade-offs and what are you prioritizing? So I think where I'd like to go with this is it's one thing to sort of be aware of the potential challenges. And I think it's really useful to have the identification of the Porsche one. That's where problems can arise. What should companies do to start thinking about climate risk? I don't know, when they're doing forward planning or strategic opportunities, what are you looking at? Enterprise risk management is one thing, but should we be looking at climate scenarios? Where are there problems? What do we do?
It's good that the regulators are pushing for action in this area. And I know we'll talk a lot about regulation, as we go through our conversation today. But I think that they've really laid a really good groundwork for companies to really think about this from an overall risk management perspective. So you think back to the TCFD, or the Task Force for Climate-Related Financial Disclosures. They published a framework in 2017 that really underpins a lot of the climate disclosure regulations that are coming globally, right? So you have things like CSRD, so the Corporate Sustainability Reporting Directive in Europe. You've got IFRS, which is a global standards organization that's taken on actually the TCFD governance. And so that is being adopted by individual countries and written into law in individual jurisdictions that are part of IFRS. So Australia, Brazil, Japan. And then you've got in California, their state bill that requires climate disclosures. We'll talk all about those individually a little bit later, I'm sure. But a lot of what the TCFD helps a company focus on is the different pillars of how they are considering climate risk, and then the way to approach the risk management. So they want to know about your governance. How are you governing and organizing your company around this? The strategy, the risk management, and any metrics and targets. And it's really rooted around what are the risks. And the one thing we don't talk about a lot is the opportunities. And maybe that's a bit of a dirty word to say, but there is some opportunity here that can, spark some action in a good way that also has strategic advantage for a company, and around your greenhouse gas emissions, your scope 1, 2, and 3 disclosures. So within that TCFD framework, they introduce a scenario analysis, which is different kind of stress tests or scenarios of how the world may play out on different trajectories of CO2 emissions. And I think you pointed out quite rightly, we are, on a trajectory today towards perhaps a warmer world than if we were to achieve net zero. But these kind of discrete scenarios help companies really think about what is the world going to be like around me. And I think this is a tricky subject sometimes because companies say, well, we are aligned to a 1.5 degree C world. We're aligned to a net zero by 2050 path. And that's fantastic. And companies really should obviously be aligned with that. But scenario analysis is more about the world around you. And you may be on that pathway, but we don't have that crystal ball just yet of what will the broader global economy and the broader global society do about this. So there's scenarios such as, let's say we do keep warming to 1.5 degrees C or 2 degrees C. In that kind of world, we have, as we talked about earlier, lower levels of physical risk increases. You might have more transition risks, which we haven't touched on yet, but maybe we could talk about a little later, about moving towards a green economy versus the hothouse scenarios. So something more akin to 3 or 4 degrees C if we continue to emit emissions into the atmosphere. But ultimately, this helps a company kind of really think very cleanly about and gives a spread of uncertainty of the types of risks it should be considering and it might face in the future. So I think those scenarios help really allow a company to think about how to create an action plan for each of those scenarios and engage the appropriate resources. Often, I think because of the financial element of it, you're seeing finance teams and the CFO of an organization really begin to lean into this. They've been used to reporting standards for many years. I mean, there have been a lot of things that have come about in the regulation landscape over the last couple of decades that took some getting used to, just like climate disclosures. But I think we're seeing that companies, especially in Europe, are starting to see that this is becoming a more regular feature and needs to be approached with the same sort of rigor that traditional financial reporting has been taking on. And you're starting to see now sustainability teams move towards the finance organization, either in a partnership mode or even more organizationally, formally into the finance organization company, because the TCFD framework and the regulators are now asking, as I said earlier, how are you governing yourself? How are you organizing the company to address these risks? And these companies are bringing together multidisciplinary task force from finance, risk, sustainability, logistics to regularly meet, collaborate, track progress against targets that they're setting. Because even though it rolls up into the CFO, everyone has a role to play. Climate impacts each of these different each of these different roles in unique ways. And unless they're all joined up, then I don't think the company can really effectively address all the aspects of climate that it really needs to. So it's really fascinating to see this kind of journey that companies are on, especially in Europe, about some companies are actually removing the chief sustainability officer role, not because they don't see the value of sustainability. I think there's just an organizational shift to bring sustainability and finance closer together.
That brings up so many questions, because there's a big debate going on at the moment about chief sustainability officers and whether they should be on the board or not, and whether it is actually being integrated across the business. There is a definite discussion around the compliance with regulation and the cost of that, and the fact it's seen as a cost center, but only by integrating what you learn from that data throughout the business can you turn it into opportunity. Then there's the issue around scenarios and whether or not they're fully robust. Because, I've heard stories, and I'm not saying this is the case now, but a few years ago, there was a case that came up that a scenario being used by, I shall not name them, an insurance company wasn't using precipitation. And you can't do that when you're talking about climate change, because if you're not putting rain into your models. And then there comes the whole question of, how does the growing impact of climate change then change the climate scenario? Because if you've got issues with your supply chain and possibly with food supply and energy supply, that's going to have a direct impact on cost of living and therefore inflation. And therefore there's all these other costs that sort of come in at the same time. So I suppose the most important thing is, as you said, that companies need to make an action plan. They need to understand which of these scenarios they should respond to in which way. But what do you actually think about the robustness of these scenarios? Do you think they're where they need to be yet? Or do you think we've got quite a lot of work still to do on it?
I've got a couple of comments on the scenarios. I think in general, if we take a step back and just think about the end state that each of these scenarios is projecting in terms of a temperature rise, yes, there will be specific natures of how a different scenario says that's going to play out for specific extreme perils. You mentioned precipitation, which is a good one. I think it's a very helpful framework overall for a company to focus its plan and potential outcomes and actions. So I would promote it from that perspective, that I think it's a really useful framework in terms of situation A versus B versus C, and it's very helpful for the risk management process. I think that there are a lot of technologies out there that are taking those scenarios and they're putting them into models. And that's where the difference begins to take shape, right? Because there are about 100 different climate modeling agencies around the world that feed these scenarios and these climate models. There are different professional and academic organizations. And the difference then becomes about how does a company or how does a solution provider interpret that data. These models that are put out there by the agencies have different scientific biases. They have sometimes poor resolution in certain regions. So a company who is putting together different models to interpret these scenarios, that's where the divergence happens, because it's a matter of you can't take all this information. You have to select certain pieces of it to make it
make sense for that individual company and its own experience.
Exactly. And more computationally more computationally efficient for the business as well in order to produce analyses. So I think that if a business is taking on a solution like this, it does, I think you've hit the nail on the head. It behooves them really to evaluate the methodology of this solution in order to make sure it's robust and fit for purpose for what they're attempting to achieve, because there are a number of solutions out there, and they do have slightly different approaches, even though they are rooted in this overall kind of concept of scenario analysis.
I think this is the perfect time to actually ask you to talk me through what FIS does to help companies actually solve these problems, because we are going to come back to legislation and regulation, because I think that is the biggest issue for most companies today. And it's certainly one that is under the most robust debate, I think would be a nice way of putting it at the moment. But so how do you at FIS actually look to help companies? Because, I've talked to a number of companies who even today are still starting out on this journey. They're looking at GHG emissions and reduction. But these days, you've got to think about nature. You've got to think about water. You've got to think about this multiplicity of different issues. So what do you do, and how do you help a business to address their climate risk exposure?
So at FIS, we've developed a solution called Climate Risk Financial Modeler. And as I mentioned earlier, we have a number of different risk solutions that are in the market, especially on the insurance side. So we've been working with insurance companies for many, many years. And then on the insurance risk side, actuarial modelers have actually been used by the insurance industry for decades now. I started my career and spent 13 years at a company called Risk Management Solutions, which was doing for the insurance industry. And that software helped insurance companies and underwriters price the premiums for different insurance policies based off of how exposed the insurance was to extreme weather. And it took rise in the late early 90s when you had major US catastrophes like the major California earthquakes of the late and early 90s, Hurricane Andrew in 1992. So there's been a long link in terms of these models that have been in the insurance industry that have linked natural disasters to claims that they cover. And I think now we're seeing the shift where businesses are now understanding the operational risks that they're facing, and they're starting to see the benefit of bringing solutions like the actuarial models in-house. And so the climate risk financial model essentially takes that actuarial framework, but kind of turns it on its head in a way, because then what we're doing is we're trying to then link the extreme weather to the outputs that a business can take on for, again, the different parts of the organization that need to be leaned into this conversation. So we have partnered with PwC in the US, who have a climate modeling and engineering team. They're the team who have gone through the climate models. They've identified the ones that they believe are best fit for purpose, and we've worked alongside them to validate that. They've also provided engineering relationships that says, given a depth of a flood or a 1 meter or a half meter flood or a certain amount of wind speed, what is the amount of damage you'd expect at a facility, given it's a warehouse or an office, or it's made of concrete or it's made of metal. And when a company can provide that information into our system, we will analyze based off where these assets are in the world and the characteristics that describe these assets, the frequency and severity of extreme weather risks that are expected to impact their facilities. So there's 12 different acute and chronic perils that we model across 3 different scenarios out to 2100. So we not only provide the long term, but we also provide a short term view, because again, this is a current risk. So we provide 5-year incremental views out to the year 2100. And we try to present that at different levels so that it is readily accessible by the different people around the table. So for example, the overall losses at a corporate level that the company could face and the overall cash flow impacts are available to the chief risk officer or the chief financial officer. But then we have the ability to drill down into individual assets within the company's operations or within the supply chain to understand, are there certain individual risks that are driving the overall risk? We speak with the facilities or real estate side of the business. They're talking about, how do we retrofit? How do we consider the building envelopes? Are our building envelopes fit for purpose for the future? Are we protecting our assets in a way that's fit for purpose with the future climate? So down at the asset level, we're looking at that. We're also looking at what they call tail risk. So, a lot of solutions provide kind of the mean or the average loss over a period, but a lot of businesses want to understand, if it gets bad, how bad could it get? And so you can look at things like what they call return period values. You hear a lot about 1 in 100 year events. So within a period, could those 1 in 100 year events become more frequent? Does that become once every 20 years, a once every 5-year kind of event?
I just love that, because I remember hearing I think it was a thing I read last year, there were 3 1 in 100 year storms.
Yes, it's when I worked in catastrophe modeling, it was a funny kind of concept to come around, because even though it's based off years, it's a way of translating a probability. So a 1 in 100 year event is actually an event that has a 1% chance of happening statistically. But it is more, I think, coming back to our conversation earlier about how to position some of these things, the years makes it kind of a more tangible and accessible way of describing it, rather than a percentage. And so, but then you end up with these kind of counterintuitive headlines about 3 1 in 100 year events happening. It's just really a matter of probability. And really what it is, does that now have a 2% chance of happening or a 10% chance of happening? The last thing I was just going to say is one aspect we didn't touch on earlier, but I'd be keen to mention, is the change in insurance. And that is an area where companies are really starting to feel the pinch. And even though it isn't a direct output of the change in extreme weather, it's a secondary but very important economic change that's really increasing costs for businesses and for homeowners around the world, right? So if you think about these actuarial models that I talked about, they've been used by the insurance industry for a long time now, but they are hit to the change in risk. And overall, insurance companies are now charging more for the same or less amount of cover, because those insurance contracts are now more exposed to risk than they were before, right? So the insurance company now needs to price that risk differently in order to maintain a profit and maintain competitive advantage. So what you're seeing is a lot of companies are starting to rethink where they're writing policies. And if they pull out of regions altogether, you start to see this in the US quite a bit, with Florida and California have been in the headlines. Florida being a very hurricane exposed region, California being a wildfire exposed region. You have seen some companies pull out of those markets. Some have set their premiums so high that they have, for all intents and purposes, pulled out of the market, but they haven't really left per se and can say they're still there, but people aren't doing business with them as frequently because it's so expensive. And there was a study done in part by Deloitte that said average monthly cost of commercial insurance is expected to rise between 8 and 9% on an annual basis. And in the most exposed areas, it could be between 10 and 11%. And that's a US-based study, but you're now starting to see this in Europe as well, where insurance coverage in some of the most exposed areas is less than 5%. And so that trend is manifesting itself globally.
Yeah, and this is something, that I think is genuinely of concern on an economic level, which is the level of uninsured losses. So not only is it a question of the individual cost to companies, but actually to the economy overall, because if you haven't insured those losses and they happen, and we've seen that happen a lot in India with the floods in Pakistan. But again, it's one of these issues that climate change always used to seem like it was something that was happening far away, and now it's affecting everybody. And I don't think there's enough discussion about how these different impacts are interconnected, because it's one thing to say we've got a lack of affordable insurance for homeowners and for companies. But if those commercial premises and those homes can't be insured, who's going to pay for them when they have, I hesitate to call it an accident, an insurance requiring event, perhaps?
Indeed, a claim.
A claim. Thank you. Much better language. I'm not in the insurance world.
And that's one aspect that we really want to bring to bear within the climate risk financial modeler, because we are able to leverage our years working with insurance companies to use some formulas to suggest what a likely premium for the risk would be for our clients. So if a client is able to provide its insurance structures and put them through the solution, will not only model the extreme weather risk from damage to their facilities or interruption within the supply chain, but we'll also be able to say, here's how much of that loss you can recover on the insurance, but this is how much more it's going to cost you. So that premium is not fixed in time. So as I said, we were modeling in 5-year increments out to 2100. As the risk changes, the premium is dynamically changing in the solution as well to overall reflect if your insurance contract becomes riskier, you're now paying potentially more for that as well. So it really kind of, what we're trying to do is try to provide that true financial cost, because if you're not including the insurance, which is a major emerging trend, you might not have the full picture.
That's incredibly important, I think, almost no matter what the size of your business. I mean, does FIS actually help advise companies on how they can adapt to this level of risk? Or is it very much a focus on understanding the financial impact?
So there's a couple ways. The solution was released late summer, and so we're still in the process of building out new functionality. There are ways in which today the company can take action. So there are ways in which we can simulate the hardening or retrofit of a building to reduce its overall risk. We have the ability to simulate a flood barrier, for example. So if you know you have a flood risk in a given area. So when you do that first initial analysis, and you can do that horizon scan, you see which assets are your riskiest, and you can see what kind of extreme weather perils are driving that overall risk. So maybe if you do have a flood, let's now test if you put up a flood barrier. Let's now see if you put up a 1 meter or so on and so forth kind of height of barrier, how does that reduce the overall financial risk? And then you can then put that side by side with, here's how much I know that's going to cost me, here's how much I reduce my risk, and how that reduction hopefully increases in time if the flooding risk at that facility is expected to increase, and you're able to do cost benefit analysis. Another way that companies are taking action today that is possible within the tool is companies are rethinking the way in which they are geographically diversifying their supply chain off the back of climate risk. So Mondelez, the snack provider, they produce Ritz crackers amongst other brands. One of their employees was in an article last year saying that a lot of their suppliers were concentrated in Southeast Asia and Australia, which has been a region that's been heavily impacted by extreme rainfall and flooding in recent years, and that's been disrupting their supply chain. So now they're thinking about, where are our suppliers overall? We need to be aware of that overall climate risk. These are the kind of due diligence questions that companies are thinking about. And so if you know the information about where those supplier facilities are, you can put those through climate risk financial modeler, and you can put them side by side and say, okay, well, I know that the risk is this today, and it's going to go in this direction. And so you can make that kind of due diligence call, pick these virtual amendments to your supply chain without putting them into practice before finding out the impact. You can get it virtually first in order to make those decisions.
This is fascinating to me because I'm interested in whether or not you work with anyone except businesses. And the reason I'm asking is because of this idea that you're actually able to model the potential impact. And I'm thinking specifically about the floods in Valencia, because I was told the reason the floods were so bad was because a project to move the river, which would have cost 180 million euros, was seen as too expensive. It wasn't undertaken, and it's one of the reasons the floods were as bad as they were. But projections have suggested that overall the cost of rebuilding and the hit to the economy is 7 billion euros, which seems insane.
Yes.
And that is the literal definition of basically saving money to lose so much more. So, I mean, do you work with cities and regions, or are you thinking about it? I'm just fascinated by how this cost benefit analysis is done for these sorts of decisions.
We are talking with private equity, real estate, investment firms, because you could definitely see parallels with a number of different industries where these sorts of decisions are required. If you're an investor thinking about what assets to invest in or divest within your portfolio, this is the sort of thing where you can kind of chop and change and make those kind of virtual changes to your overall business before then making that change in real life. So I think it's at this stage, it's more at the kind of the decision making of the assets themselves rather than broader kind of infrastructural changes, shall we say, like the one you mentioned in Valencia. But there is still quite a lot of power in the ability to say, well, if I want to work with that company, what is that going to do for me? And it flows back into that conversation of the TCFD framework, because if the whole business is kind of aligned around that and understanding what goes into that, and then that's publicly disclosed, you now know that that's going to be disclosed next year and the year after that. So why not bake it into your decision and due diligence process such that, think ahead to what's going to be disclosed next year. This decision that I make might have to then be part of the disclosure. If you don't do that due diligence and suddenly you're on that river, that supplier's on a river, and that then may flow into your reporting next year. So just, I think, having the awareness that that's going to be on the books on an annual basis from here on out, hopefully will drive smarter decisions in this area.
Well, I think it's that thing of transparency obviously matters, and that's been a driving force behind financial reporting for years. But it's what you do with that transparency. And as you say, it's actually taking that data and making decisions with it that help move the business forward. Because I remember hearing stories back in the day, of a company that was reporting certain risks in its CDP reporting that weren't in its financial reporting, and then New Orleans flooded. And, that was a bit of a whoopsie. Everyone on the environmental side knew that this was an issue, but no one on the financial side had discussed it. So there does need to be a much closer connection between an understanding of these risks and what it means for the business. But I think this brings me back to the thing we need to talk about most, the compliance, the legislation, the direction of travel, because we know that compliance has been increasing. We know that regulation and the requirement to report is on the increase. It seems as if the direction of travel is unstoppable, but at the same time, we've had a more right-wing government elected in Europe, which is now putting the CSRD, the CSDD, the due diligence directive, deforestation back through an omnibus process. We're hoping it's not going to weaken the legislation, but we don't know. In the US, we've got California, as you mentioned, which is, I think the legislation recently overcame a hurdle.
That's right.
And it is set to be implemented. But at the same time, if Trump pulls out of the climate agreement again, what do you think is going on? And do you think it's more than just the legislation? What do you see as the key drivers for climate risk management?
I think, as you said, I take some solace in the fact that companies are guided by regulation and act upon regulation, and the fact that you're right to say about all the headwinds that we have. I think that we still see a good trajectory of adoption of IFRS standards in countries where they are part of the IFRS framework, potentially in Canada. I guess there's an election coming up in Canada, so we'll watch that closely. But I mentioned Australia, that's been signed into law. Brazil has been very forward in this area. Japan, a couple of African countries, and as I said earlier, the UK. And then California, it's interesting that these disclosures are not whether or not you're based in these jurisdictions, it's if you do business in these jurisdictions. So California alone, I think if it was its own country, is somewhere around, I think something like the fifth largest GDP. Yeah. So between CSRD, let's assume hopefully that it remains mostly intact the way we know it today, and California, and then these other countries that are adopting IFRS, I think that some of the world's most major companies are still going to be disclosing in one way or another. But you've got a number of U.S. companies who are already preparing for CSRD and have been for some time because they know they do significant business in the European Union. And so I'd like to hope that despite some of the changes that are occurring at the governmental level, as you mentioned, that the disclosures and the regulations will remain intact and companies will continue to need to disclose and act. I think the one thing that I'm looking for is whether or not changing political pressures or geopolitical risk will start to compete. And well, they already have, let's be honest, they already have started to compete with climate. And so there's a couple different directions that goes, right? So I was at a banking conference recently, and they were asking, what are your top risks? And I think climate ended up fourth or fifth on the list. So they've polled the audience. But also,
it's understandable.
Exactly. Who's to argue with Russia, Ukraine, broader geopolitical risks, cybersecurity, the change in tenor and the change in overall government relations. So there's a lot on a risk manager's plate today. So there's a lot of competing attention. And then I think that we've started to see in the US, political pressures start to dissolve some of the alliances that we have between businesses and institutions towards achieving net zero. We had, for all intents and purposes, the dissolution of the net zero insurance alliance off the back of pressure from the US Congress around potential antitrust violations. And you just had recently Goldman Sachs leaving the net zero banking alliance. And you've got these companies that say, okay, well, we're going to leave the alliance, but we're still very committed to our overall transition goals. But at the end of the day, even if they were to achieve these or continue to strive to achieve these, it's going to happen in a very disorderly way. And this actually comes now full circle to our scenario conversation, because climate scenarios inherently, again, for the sake of, I'd say, simplicity and straightforwardness, assume an orderly transition to whatever end state that the scenario talks about. There are a few scenarios that are starting to be adopted that are called disorderly transition scenarios, in which not a lot of transitional change or societal change happens in the next couple of years, but then it all ramps up in a very kind of chaotic way to 2050. And what that disorderly transition means to the world and to business is that it's a much costlier transition, because it's not organized. It's not done working together in concert. We had some good progress where companies were saying, hey, let's put aside some of these competitive differences. We know that this is a much bigger problem that is best if we tackle it together. And we know that we can still remain competitive within that framework, but let's work together towards some of the most fundamental issues like packaging and so on and so forth that we share together, that transcend competition. Without these sorts of alliances, the potential for that cooperation decreases, and overall, unfortunately, means that we increase the likelihood of a hothouse world and that increased extreme weather. This is an area where there's still that potential, of course, that we reach our goals, but the probability starts to go down if we don't start working together on it.
Well, I think it's one of those things that is challenging when you talk about the geopolitics and how in the banking conference, climate change was so low down the list of risks. Because part of the way I look at it is that climate change is a risk multiplier. What it does is it makes all of those risks they think are more important, more damaging, and more potentially dangerous. That's really bad. I think the idea that sectors won't work together is also a concern. Because, as you say, this idea of working together on solving fundamental problems is really important. But I suppose in the end, what it boils down to is we have to persuade people that this is a problem worth addressing. And in many ways, I'm really grateful to you for bringing up the insurance side of things, because if you're actually able to say, this is a risk that will cost you money, this will impact your share price, then in those decision-making circles, that becomes really, really important.
Yes. And I think that, again, it's almost a little human nature that it has to come to something. It has to come to a climax or an event to act, especially when, you can't fault these professionals at the banking conference. It's not that they say that climate is probably the fifth most important risk.
It's just there's others that matter more.
It's so many others, especially today, right? Yeah. And especially, that conference was November of last year, and we're in the wake of the election, in the wake of a lot of development geopolitically. So of course they're top of mind, and especially for a business, inherently they're thinking about tomorrow. And it's very difficult to get them to think beyond the traditional window, because a lot of people, that's
not what their job is.
And the average tenure of a CFO, I think most CFOs, I believe, are in post for less than 7 years, and a significant portion of them are in post for less than 5 years. So that's their duty to the business, right? And I think that, again, that consciousness of now it's happening today starts to spur action, because now it's affecting the bottom line today. That Porsche example, and again, the World Economic Forum example, the 2-year outlook. I think this is probably the turning point where companies start to really bake this into their overall risk management, because it's happening today, and it's happening really at a societal level. I think it's difficult to get that message across more broadly societally, and I think people are really leaned into it, because at that same conference, someone showed a survey in which, despite all the the changes politically, I don't think there was any country globally in which there was a majority of people who did not believe that the climate it needed to be addressed. And so there's obviously public awareness that there's something happening and that something needs to be done. I think there's sometimes you don't know what to do or how it's going to impact you, but again, it will start hitting people's day-to-day costs. I mean, a classic example, this is my parents they've recently retired, and they've done that thing where people from the north of the US do. They moved to Florida in the winters, and they went to get their auto insurance down in Florida, and it was triple what they were paying for auto insurance in the state of Pennsylvania. And a lot of that comes down to cars in Florida. I mean, there are many reasons, but one of the main reasons was cars in Florida take a lot more wear and tear from natural disasters, from the overall heat and humidity, the repair frequency and the repair costs of automobiles in the southeast of the US vastly exceeds that of the northeast of the US. And so people will start to take notice, I think, as this starts to impact, again, insurance, grocery prices. If you start seeing shortages of certain products in the future, or prices go up, because if you think about it, a lot of these risks are going to be passed on from companies to consumers in a lot of ways in order to kind of recuperate some of that risk back. And so I think there's an opportunity here, I think, for companies to communicate more transparently with the general public are in this space. Again, we talked about balancing risk and opportunity, and I think this is one opportunity where companies can gain reputation if they are able to communicate in an effective way. We have to watch out for greenwashing, obviously, but effectively communicate in a way that they are providing products to the general public that are doing good for the world, but also helping people's bottom line.
I think that's a perfect place to draw our conversation to a close. Tom, thank you so much for joining us. It's been really, really interesting learning actually about how you can try to incorporate climate risk as a business and what that means for wider industry as well as any individual business. So it just behoves me to say thank you again to our listeners. I hope you've learned some really useful things, and we'll be back soon.